Okay, another one we've been waiting for. It's going to be Home Depot's earnings, right? This is one that was pretty exciting to me because I think this has been a very good year for home improvement. And I think we may see a little bit more of an impact in Q2 for this company. But I'll definitely be excited to take a look at these earnings and see what they have to offer. But there's really a lot of benefit for these home improvement stores right now as long as they take advantage of it because of the fact that a lot of people are going to be focused on home improvement. If you look at the Google Trends, I don't have it pulled up here, but if you searched it up, any kind of home improvement item, you see a big spike right now as opposed to typically every time around this year, you'll see a spike like that just for spring, people are really focused on gardening, stuff like that. But this year you see a lot bigger of a spike. A lot more people are interested this year because, again, due to lockdowns, people have nothing else to do and they want to do projects at home. So Home Depot's got a great ability here to hopefully succeed, but they're down 1.2% pre-market. Market's about to open, but we'll see where it opens at right at the end of this. But let's look at these earnings. So Home Depot missed by 18 cents on a gap basis, $2.08 gap. Not a big shocker to me, all things considered. There's a lot of expenses going on right now, just with how the entire world is. It doesn't shock me at all that a company misses on a gap standpoint. Think about all the money that they have to spend just to maintain business right now, to keep in business. It's not a shocker at all. What's very nice is that revenue number, $28.26 billion, up 7.1% year over year, beat by $690 million. Love those numbers. But it's a good beat. It's a very good beat. Very nice. See, obviously the market didn't react pretty nicely to it just because of the fact that EPS line wasn't where they wanted it. Or they haven't reacted nicely so far. We could see where it ends up. But, I don't know. Nothing super exciting going on with these earnings. But I think that revenue beat's nice. So we'll take a look here at some of this and then look at their press release. And take a look at this stock. So, reports comp sales rose 6.4%, topping the consensus of 4.5. That's massive beat right there. Comp sales in the U.S. stores are 7.5, above the consensus of 5.8. Nice. Gross margin fell, not a shocker. 10 basis points isn't that massive. SG&A expenses rose 190 basis points. Operating margin fell 200 basis points. It doesn't shock me 100%. Good grief. Customer transactions declined 3.9%, while the average ticket price increased 11%. And we saw the same thing when we looked at Walmart. It's the same story. People are buying more. You have a little bit less people coming in, but people are buying more. We have stimulus checks. We've got tax returns. There's a lot going on. Sales per retail square foot up 7.2%. It's a very weird metric to measure, but if they're doing it, that's fine. Store count increased for 4 year over year. 4 more stores this year, or in this quarter, I should say. The company is suspending the guidance as there's uncertainty, and all these companies really are because there's no way to really determine it, especially in a market like retail, where you don't know when people are just going to stop coming in. It could be in a day. They just decide, well, we're going to lock down more and not do anything. And with how the government's treating it, you don't know if they're going to let you freaking do business at this point. Gosh dang. Lucky enough for Home Depot, they were considered essential, so they were able to be just here and operating during this quarter. They also announced an inline dividend, so no decrease in dividend there, $1.50 per share, pretty nice. Obviously, they can afford it as they posted a $2.08 number, so, and they have the cash to support it, but nice they're keeping the dividend. They support associates with approximately $850 million in expanded benefits. You see Walmart gave out bonuses of around $800 million. This isn't going to be in bonuses for Home Depot. Some of this is going to be in increased pay. Some of this is going to be in, stuff like healthcare benefits that they gave. Not all in bonuses, though. So nothing crazy there. Their press release obviously isn't massive because you think about Home Depot, they're relatively limited in what they have going for them for the most part. And support these two objectives. The company took several actions to prioritize safety, to promote safe environments and associates. The company implemented a number of operational changes mid-March, including closing stores earlier, which they did do that, and they don't get a lot of business in those later hours. But that includes more time for sanitation and replenishment of essential products, limiting customer traffic in stores, canceling traffic driving events such as Spring Black Friday, which is a big hit for them, obviously, but people still went out and they went to buy it, and I'm sure they got a lot of complaints about it. Gosh dang, let me tell you, people complain about anything, especially in this time. Do you think people would be more grateful? I'm sorry. People are not grateful right now. Some are. There's some really nice people out there. But there's a lot of people who are just general jerks. I just didn't know if you knew that. But don't go out shopping if you're going to be a jerk. I'm just going to tell you that right now. Get roasted, buddy. So let's see. So, yeah, very nice here. They expanded paid time off for all associates with hours that can be used at their discretion. Again, that's part of their $850 million benefit. Provided weekly bonuses for associates in our stores and distribution center and doubled overtime pay. Frick me. Wish I was getting that, baby. Whew. Extended dependent care benefits and waived related copays, and that equates to their $850 million, where Walmart's was simply just bonuses, really, for the most part. And they also offered, I guess, an additional stuff there. So definitely interesting to see how these retail companies are taking care of their people. It's pretty nice. Net earnings for the first quarter of fiscal year 2020 were $2.2 billion. Nice. We like that. That's a good net income line compared to net earnings of $2.5 billion in the same period last year. So year over year, you saw an EPS decline. Not a shocker 100 at all. I mean, there's a lot more expenses going into this right now, so that's not a shocker at all. EPS decreased 8.4%. Not bad. So guidance, obviously they're going to cut guidance. Going to cut guidance because you don't know what it's going to look like. So, I mean, there's a lot going on for this company. They didn't really mention much in this press release. But I think Home Depot's got a great opportunity for next quarter. I think they should be doing pretty well. They should benefit pretty well, especially because we're talking about more tax release or more taxes coming in, potentially another round of stimulus checks, which people will absolutely use those stimulus checks to fund home projects, because I know a lot of people personally that are doing that. So you'll see a big benefit in that aspect. Let's look at this balance sheet real quick for this company. So, current assets right now for this company, they're giving me a lovely year-over-year comparison. So right now they have total current assets of $27.2 billion versus $20.5 billion last year. Good increase in terms of cash. Total assets in general, $58.7 billion versus $51.5 billion. So a very good increase year over year in terms of assets for sure. You'd like to see that. But from a total current liabilities perspective, that increased $4 billion, $23.3 billion versus a $19.6 billion number. And total liabilities increased to $62.2 billion versus a $53.6 billion number for last year. So that increased nearly $10 billion. Yikes. I don't know. I mean, for me, it seems a little crazy to this stockholder or deficit really is increasing. I don't know. I don't like the looks of that. It's not a beautiful balance sheet for this company. I think they need to turn that around. I don't know. Maybe I'm crazy. And this isn't a good time for not a beautiful balance sheet, just due to the fact that, I mean, they have the cash to support through this, but they can't really keep increasing that debt that much. Expenses are going to keep rising. You don't want to have a bad balance sheet in these times. And it's not a beautiful balance sheet. You don't want to see stockholder deficit in these times. And I think definitely that's probably going to drive some investors away from this stock. I'm currently invested at around 150 as my cost basis. I don't plan on selling because of this, but I don't like that balance sheet number, and I think it's something you need to take a look at before you consider buying this stock at the levels it's at. let's see. Let's refresh there and get a chart as the day opened. So now down 3%. So, and the PE ratio is not absurd, but you're going to see that decline a little bit. I just don't know with that cash, really with that balance sheet, I don't know if it's necessarily worth it at this current PE ratio, because you're going to see probably a worse second quarter, but it should be pretty good. It's not going to be as good as the first quarter probably. So if costs just continue to increase, it's going to be rough for them. That's all I can tell you. Because most of those expenses that they took for associate safety and stuff, they're going to affect Q2 more than they affect Q1. So you really want to see more profitability coming out of this company, and hopefully they can post that. But I don't know if the stock's necessarily at a point where it's a great pick for me to pick up shares. I think under 200 maybe. I'm not saying it deserves to be under 200 necessarily, but it hasn't been there since April. But this run-up has been pretty rough for it. I mean, it dropped down to 150. I wish I had bought some more, by the way, back here. Just imagine if you bought some more back there. Oh, up 56%. It's been a crazy run-up, so I maybe would stay off this stock. It's a little too hot right now. I mean, you know it's hot when year-to-date. It's a retail stock, and it's up 8%. So it's a little too hot right now. Maybe stay out of this for now. Pretty crazy, but do hope you enjoyed.